our source and use, our pro forma balance sheet, we modified our model, we modeled our exit, we calculated our cash flows, we got down to a return of 21.3%. Question now is it good enough? Is 21.3% enough to justify our doing the deal, our managing the deal, our being involved in helping the company strategically over the next 5 years, all the management time and effort it's going to take? Will this give us enough of a return to justify all that time and effort and risk associated with the deal? And really it depends on what our hurdle rate is. If our hurdle rate is 15%, this is probably a pretty good looking deal for us. If our hurdle rate is 20%, it's probably okay, but a little bit of a slip in the performance of the company, or maybe the economy goes into the tank, a little bit of a slip, and maybe now all of a sudden our returns are underwater. And now we're just working to preserve capital. Now we're just working, to get a very low-level return. We won't ever get to the carried interest level. And that's what general partners want. They want to get that carried interest. That's where they make their money, as we talked about yesterday. So if a GP, if a general partner in a private equity firm is knocking the cover off the ball, that is, they're doing deals with a 21.3% of return, rate of return, when their hurdle is only 15%, they're taking home a lot of cash. If our hurdle rate's 22%, though, we're probably never going to get to the carried interest level. Our returns are going to be pretty mediocre. Does that make sense? So at the end of the day, it becomes a judgment call. And usually it's not such a clear-cut situation where you look at it and the numbers are just so far above the hurdle rate, it's a can't miss deal. Usually there's going to be some sensitivity involved in the modeling. We'll go back, we'll run an upside case, we'll run a downside case, we'll run some cases in an increasing interest rate environment, maybe a decreasing rate environment. We'll try and really dig into the model and help understand the risks associated with this deal. It's usually not just a go or no-go decision. It's usually not that easy.
This is like dollar size factor into the decision?
Well, it will. A private equity fund, take Blackstone for example. I think their last fund before the music stopped, so to speak, last year, I think their last fund was like $20 billion. Right? So they need to get that money invested as quickly as possible. Get it out in the market, get it working, so that they can start selling investments, realizing cash returns, and get back to raising their next fund. In private equity, it is, to an extent, it's all about getting that money deployed, turning it over, getting back out to the market and raising more funds. Because if you can imagine, a firm like Blackstone, if they've got a $20 billion fund and they're taking a 1.5%, 2% management fee on that, that's real money. Okay. There's a reason they were excited to get to 20 billion. 1% on 20 billion is a lot bigger than 1% on 5 billion. And so private equity firms, they want to turn their money over as quickly as they can, get back to the market, raise ever bigger and bigger funds to drive those management fees. Those management fees come in, and private equity firms are pretty small. They're not, for the most part, they're not firms with thousands of bodies around that need to get paid. Usually it's a small group of very highly compensated, highly skilled people running that private equity firm, serving as the GP on deals and splitting those management fees. So 1% of 20 billion splits really well among, say, 30, 40, 50, even 100, couple hundred partners, as the case may be. So private equity firms intentionally limit their size. They try and get bigger dollar amounts. When they get bigger dollars under management, they have to do bigger deals. So a deal like this, where they're only putting $100 million in, probably isn't very economical for a Blackstone if they've got a $20 billion fund. You got to do a lot of $100 million deals to get fully invested. And it's kind of a paradox of private equity. As you get bigger, you have to look at bigger and bigger deals, and there are only so many of those out there. There are only so many lenders that are going to be willing to step up and fund those big deals too. So there are probably some theoretical limits as to how big private equity can get. Now the Mezz fund is going to be set up probably pretty similar. They invest at a different level of the capital stack. They take on different levels of risk than the equity investors, so they probably have a different required rate of return. but at the end of the day, their decision-making process is going to be similar. Do our returns exceed our hurdles? Does it make sense for us to do the deal, to take on the risk, have our money deployed for 5 years? Is it going to lead to us getting highly compensated at the end of the day? So a mezz lender is going to run the same type of returns analysis. So their initial loan will be that first cash flow. They're putting in $60 million at time zero. They're not ponying up any additional cash the next 5 years, just at time zero. Okay, they receive no cash interest at 12/31/08. 12/31/08 is just a split second in time. That's the closing table. That's when the deal gets closed. We will, even though they're not getting cash interest in this model, we will link to the cash interest line in our debt schedule to our model. Just in case the terms change at some point, we'd want that to automatically flow in. So we're going to link to I-150 for year one. Copy that across, paste special formulas to paste. So again, it's zero in every period. The first zero at 12/31/08 or time zero is a hard-coded zero. The others are linked to the cash interest line in our model. Principal repayment at sale. The first 5 periods are zero, right? Because they're not getting paid their principal until the very end, until the company is sold, until the remaining debt gets taken out. Their principal is part of this 186.6 that we modeled over here. But we'll also pull this from the model. So we'll say equals that 96.6 million, which is in cell M148 in the model tab. And then also at 12/31, they get that warrant, or they get that warrant cashed out rather, which we've already calculated the value of that. It's in B42, it's that 14.4 million. So as I said a moment ago, they're going to get something more than just their interest and their principal repaid. They're going to get that warrant value at the end as well. And if we sum up their cash flows just like we did for the private equity firm in each year, we can now calculate a return for the mezz lender using that same XIRR function, specifying our cash flows first, then specifying our date range second. And when we hit enter, we should get a return of 13.1%. So something north of their interest rate. Their interest rate was 10%. That warrant in year 5, that warrant value in year 5 bumps their returns up to 13.1%. If there was no warrant, let's just delete that. Their return is just their interest rate. It's just bond math. Okay, but the decision-making process, as I said, very similar. 13.1%, is it good enough? If we're the mezz lender, does that significantly exceed our return hurdle? If our return hurdle is 15%, then we're not priced highly enough. Because 13.1 won't cut it. If it's 12%, then maybe it's pretty good. And that's how these mezz lenders price their money. They've got a target. Just like private equity. If they don't get over and above it, they don't get carry. If they don't get carry, then they're spending a lot of time and effort to get pretty meager returns. All right, and the next thing I want to do, I'm going to do it up here. You don't have a space for it yet in your model. Because now I'm going to show you how to do this, how to use this type of model as a fourth valuation methodology. All right, so really what I want you to do is follow along with what I'm doing on the screen, understand the concept, and then at the end of the class, if you want a copy of it, I'll give it to you, and you can have it for yourself. But this is kind of a difficult exercise to follow along with in Excel. We're basically going to work backward all the way through the model, through the exit, through the source and use, all the way back, and try and figure out what a private equity fund, the maximum that they could be willing to pay given a finite universe of assumptions. This is an exercise that we might use if we're an investment banker, we're representing a company in an M&A scenario, and we're trying to answer the question, what might the company be worth to a financial buyer, to a private equity firm? Given a certain state of the capital markets, given a set required rate of return for that private equity firm, etc. Does that make sense? Kind of an interesting exercise that as a banker we could use this if we've got some really good information as to things like how much debt would be available to do a leveraged buyout on this type of company, if we know who the likely financial sponsors are out there that might do this deal, if we know what their required rates of return are, it can give us a good sense for what is the maximum they can be willing to pay. And obviously, if we have an idea of that, it's pretty useful at a negotiating table, right? If you know what the other party can pay, then it helps to know how far that you can push them in the negotiations. So that's probably a scenario in which this would be useful or could be useful in the real world. What we're going to do, and as I scroll down below in my model, again, you don't have this, you shouldn't have this at this point in your model, is I've got a valuation template that we've created. And what I'm going to do here is I'm going to run 3 general scenarios on the exit. I'm going to run a base case on my exit, assuming something similar to what I assumed over here. I'm going to assume that as my base case, my most likely case, this company should be able to be sold for 6 times EBITDA at the end of year 5. And then as we talked about a moment ago, I'm going to run a downside case where maybe the world's not going to look as rosy as we think it will sitting here at time 0. Maybe this company can only be sold for 5.5 times. Then we're going to run an upside case. Maybe it can be sold for 6.5 times. Within each of those 3 scenarios, I'm going to run 3 additional scenarios to sell for what 3 different or a range of private equity buyers might be willing to pay if they've got a certain specified range of return requirements. That'll become more clear when we get into it. But that's basically the outline for what I'm going to do. So I'm going to start with my base case. And as we talked about before, my base case is going to involve a multiple of 6 times. That is, I think most likely, the end of year 5, I can sell this, or an owner of this company could sell the company for 6 times EBITDA, which if we multiply that by EBITDA at the end of year 5, gives us what should be a familiar value, $459.5 million. This first section here in my base case is going to mimic what I did over here. It's only once we do 3 additional cases within this base case that you're going to start to see some divergence and start to see a range of values starting to emerge. All right, so I multiply that by 76.6. And another implicit assumption here is that we buy the projections, that we really believe that most likely the company will be generating EBITDA of $76.6 million by the end of year 5 too. There are a number of assumptions we have to make, and you'll see those play out. But that's one of them. Okay, if we add back cash in 2013, we subtract debt. Notice as I go through here, I'm locking on a lot of these cells because I'm ultimately going to have to copy them. My transaction fees are minus 0.01 times my enterprise value, minus 2, which would give me, also not surprising, an implied equity value of 287.3. If I multiply that by my take, 95%, it gives me that 272.9. Now this 95%, of course, rests on the assumption that a capital structure similar to what we've explored above would be available to purchase this company. All right, that is, we could raise so much debt, and as part of that, we'd have to give up a 5% warrant. Does that make sense? And that's something our leveraged finance group probably be able to tell us. If we're an investment bank, we've got a Lev Fin group. You can take a look at this deal. say, okay, a company in this industry, packaged foods, you should be able to get 4.5 times leverage. A debt package is going to be structured roughly like this. You're probably going to have to go to a mezz piece, and as part of that mezz piece, you're probably going to have to give up a 5% warrant. Right? It's an assumption. Okay, whether it's actually true or not is, kind of neither here nor there, but it's whatever we believe is most likely. All right, so we know what our exit could look like under a base case scenario. Next thing I want to do is specify 3 different required rates of return. Basically a range of required rates of return, and this could be, I'm setting it up so it ranges anywhere between 15% and 25%, with kind of an average or middle value of 20%. I could have these vary by less, have them vary by more. I think 15 to 25 roughly encapsulates the world of private equity required rates of return. It's probably even a little tighter than that, to be honest, but I think it's a good rough approximation. And if we believe that value to the sponsor could be $272.9 million at the end of year 5, the question becomes, what would a private equity buyer, what would be the most that they could pay for that stream of cash flows at time 0? And at this point, it's really just doing some math, solving using the time value of money. For a given rate of return, here, if we go over here, put the time value of money formula back on the board, we take a present value, we multiply by 1 plus a rate, raise that to the nth power, gives us a future value at time n. Okay, well here, we've got an idea of what that future value can be. It's our exit value, or the value that would flow back to the sponsor after we exit. So if I do some math, solve for present value, if I take my future value at time n, divided by 1 plus my required rate of return, raised to the nth power, n being 5 in this case, I can solve for what that initial equity investment should be. So the math is, if I take my value at the end of time t5 divided by 1 plus my rate raised to the 5th power, tells me that private equity buyers with this required rate of return and this cash flow at the end of year 5 would be willing to pay no more than these amounts at time 0. And not surprisingly, the private equity firm with the highest required rate of return can put the least amount of money into the deal and still meet their required return hurdle. Does that make sense? Their money is more expensive than the other 2 private equity firms, if we assume this is just 3 firms. You can typically find out a lot about private equity firms if you can get your hands on their prospectus, their PPM. It will tell you what their waterfall structure looks like. It will tell you generally where the breaks are, and you can figure out what those required rates of return are for the PE firm. It's really what is the point at which, or after which, the cash flows start to flow heavily back to the general partner. That'll give you a sense of where that return hurdle is.